Good day. I am Mark Sebastian. I am the founder of OptionPit.com. I am the Chief Trading Officer, Chief Investment Officer of Carmen Line Capital. I am the CEO of OptionPit. I am father of two, and I am junior husband to one, because we all know who's in charge. But it's good to be here, and we're going to talk about butterflies in weekly options. All right. So we're going to talk about butterflies, and so today I'm going to talk about myself, which is my favorite subject. Then I'm going to talk about butterflies and direction, and a little bit on directional trading using flies, and then if we have a little extra time, I'll briefly talk about maybe even the dailies. But that may be our next, the next iteration of this. We may have to do an entire class all on trading daily options. And then dailies and binaries are going to be kind of an interesting thing. All right, so that's me. If you don't know who I am, then Andrew did a great job on the gold course, the course a couple of weeks ago, pitching this course. But I am the founder. I was a floor trader for almost a decade. I went through Group 1's training program, which is what and Group 1 is what, the 6th largest market making firm in the world, 2nd largest independent market making firm in the world. So it's up there. Once you get past the Goldmans and the big banks, there's only Susquehanna and Group 1 that are really market making professionally. And so we were pretty big, and I went through this entire training program. It took about a year for them to let me trade. And the guy who actually developed that training program happens to be my business partner, Andrew. So you're learning from the guy who taught me how to trade, and the guy and myself. So you got the cream of the crop here, folks. And we put our money where our mouth is, because in addition to running OptionPit, which is a great education and consulting business, I run Carmen Line Capital, and Andrew runs the risk for Carmen Line Capital. So we're involved in the markets, and we're involved in education, and we love what we do. So today what we're going to talk about is how weekly options decay. We're going to talk about the different uses of weekly butterflies. I'm going to talk about broken wing weeklies. And I'm going to talk about a little bit on directional weeklies, and I'm going to be talking about directional using flies as well. All right, so weekly options were initially listed with 1 week. All right, just that first week, and then the regular month. Well, they had this kind of crazy, herky-jerky back and forth decay. And so really, they don't do weeklies this way very much anymore. Only when they're first adding weekly options will you see a contract that has 1 weekly. Now they're adding, in most cases, there's going to be 4 weekly options trading at any given time. All right, they begin 4 weeks around that standard contract month. So if I pull up live, oh, I thought I had it open. 1 second. So if you look at Facebook, they've got the regular September, then they've got September 2s, 9s, 23s, and 30s. And in fact, in some of the really active names, they'll go as far as 6. All right, less ones you'll see more like 4 typically. All right, but they'll add a lot. And the idea is that people want flexibility in where they set up their trades. So so someone asked Monday and Wednesday. They have in SPX right now, they have 3 expiries a week. And actually there can be as many as 4. if we get into a quarterly, so if you look at the quarterly, step 30, which is the quarterly option, that is going to be, the 30th is a Friday. All right, so if the 30th was a Thursday or a Tuesday, all right, you could have an option expiring on Monday because they just added Monday options last week. You could have an option expiring on Wednesday because they added Wednesday options about a month and a half ago. You could have an option expiring on Friday, which is standard weekly expiration, and you could have that quarterly expiring on that Tuesday or Thursday. So that's as many as 4 days of options expiring in a week. And we are going to go to daily options in SPX and SPY within the next year. The idea being that if there is a day that you want to trade an option, it will be available. All right. Now, these are not binaries where it's 100% win or 100% lose, or they go to 100 or 0. These are standard options, but they trade daily. My guess is that this type of stuff is going to put Nadex out of business. Or put them up for auction. All right, I could see Nadex getting bought by CME or SIBO. They would be a fit there. Like if CME bought Nadex and then you could clear through CME and trade Nadex, I think a lot more people might trade it. Or if Nadex cleared OCC, I think that that would be a much better, you could do really well there. But yeah, they're going to add daily options to SPX, and when they add them to SPX, that means you usually get them in SPY. So I fully expect there to be daily options in SPY. They're not going to add them to VIX. They're not going to add them to, you know, you could eventually see Monday, Wednesday, and Fridays added in names like Apple or things like that, but there's some structural problems with equities that need to be fixed first before they can add more options because the liquidity stinks. All right, in equity options right now because of the auction process. All right, now, weekly options basically now kind of act like normal options. They just decay off, decay off, decay off. All right, there might be some edge in some of those dailies when they first list them, so I'm going to have to do some investigating into those. But right now, there is no secret sauce to trading these weeklies. There's no, because they list them so far away, there's no, no easy way to just sell premium in these weeklies. All right, now, weekly options allow for targeting risk to term. When does a trader want the risk to appear and disappear? That's the value of the weekly option. I can trade around events, I can trade around earnings, I can trade around all sorts of things. I can target non-farms, I can target the FOMC, owning, being short, all sorts of pieces. They allow for pinpointing events. All right, and Andrew's going to cover this in calendars. The targeted term structure trading is quite possibly the most valuable piece of weekly options. I'm going to talk about butterflies and directional trading, and I love flies for directional trading using weeklies. For at the money stuff, Andrew and I consistently find that calendars are better than flies, especially in this low VIX environment. If the VIX increases, then butterflies start to look really good. But we've been in a low vol environment for a while. All right, so, you know, just briefly take a look at earnings here. All right, this is Nike. So based on the implied volatility of these options, when right now, if I pull up live vol and I look at Nike, all right, Nike had earnings on June 28th, but last year around September, they had earnings on the 24th. So my question, you've got a weekly on the 16th, the 23rd, and the 30th. When are Nike earnings? When are Nike earnings? Yeah, they're going to be on what's interesting is the market thinks there's some chance that they're sometime before September 23rd. But they are 100% certain it's before the 30th. And they are 100% certain it's after the 16th. So this is going to be the interesting contract. Because when Nike releases their earnings date, either the September 23 weekly option, the vol is going to either go to 24.75 or around 18.25 based on what I'm seeing. So there might be a targeted trade here. All right. So that's one way to really just, even if you only want to trade monthly options, that is one way to trade weeklies effectively. Can a company change their earnings date? They can. What's going on here, though, is that the market isn't sure, based on that SEP 23 date, whether Nike might report on September 22nd or sometime the following week. So that's why that appears that way. All right, now, just briefly talking decay. One of the great myths of option trading is decay. Many traders think that this chart is the end-all be-all, right? The exploding decay. Talk about this all the time. There are so many people out there just saying, oh, look at the way decay explodes. All you have to do is sell options and you'll win. It ain't that easy. It ain't that easy at all. Decay is not a secret sauce. Everyone knows about it. There is not the edge that many think is there. I mean, if I'm sitting here in a webinar discussing decay, how can you have a SEP 30 weekly? Well, the expiration is on that Friday. When it says SEP 30, when we look at weekly options, let me just make it very clear here, folks. These dates are all the Friday they expire. So, we as retail traders, or you as retail traders, understand that there's this decay phenomenon. But do you really think there's that much edge in it if it's gotten down to in just being blanket selling options, selling premium, if I'm giving a webinar on it? Well, let's think about this. How many professional traders are there out there that are currently sleeping after partying their faces off last night at some club that fully understand concepts of decay? Thousands of them. All right. And so the idea that there's easy money selling options is just wrong. Now, there's money in selling options, but it's not easy, and you have to know what you're doing. All right? But if you understand how to structure decay trades, you can set yourself up to have some edge. Where decay speeds up, where it slows down is key. So remember, decay is exponential at the money, but it is a moving target. At the money moves around. Now, out of the money options, decay more linearly. So we're talking options that are, 25 delta or lower, have a more linear decay. And then out of the money options, sometimes called little units, options worth less than 10 cents, have almost no decay. Understanding decay means understanding income structure, means understanding how to build the trade. All right, so decay is linear at the wings and explosive at the money. All right, the blue line is wing decay. The black line is at the money decay. And notice how they converge. And what position benefits from this? Butterflies. Butterflies are the best way to harvest out of a weekly trade without taking a directional opinion, and staying within one term. When I say term, what I mean is that week. If I want to have an absolute defined risk within 1 week, butterflies are the way to do it. The crazy thing is how short of a period is necessary to take advantage of a butterfly in a weekly contract. Pigs get slaughtered. Smart little piggies that go to the market can buy roast beef. By the way, did anyone ever... there's really no difference. Question was regular butterfly or iron butterfly. There's really no difference. I tend to do iron butterflies just because that's the way I'm used to trading them. It doesn't matter. A iron butterfly and a regular butterfly should have the same value or the same P&L chart in the end. By the way, speaking of that little piggy thing, and I'm going to go on a small tangent here, folks. Does anybody find it disturbing that pigs are eating beef? It's just like I find that eat more chicken posters from Chick-fil-A where the cows are painting. I mean, when you think about it, like you're talking to your kid, this little piggy went to the market, this little pig stayed home, this little piggy had roast beef, this little piggy had done. What is up with that piggy? He's like, oh yeah, I'm going to eat a cow who lives in the stall right next to me. I know pigs eat everything. I'm aware. I actually have pig farmers in my office. But it's just fascinating that, exactly. It's like, what was that Snowball? What was the, Snowball was the evil one in, was the evil pig. What was the name of the main pig in Animal Farm? Anyway, so it's a little tangent there, but really, you're when you do that with your little kid, you're basically, there's something sick and twisted in there. Then again, we do also do nursery rhymes about a bough breaking and a cradle falling to try and get a kid to go to sleep. All right, now that I'm off that tangent, let's look at some butterflies. So this is Apple. This is from this week. All right, this is from Monday. All right. So Apple 106, 109, 111 fly. So this is a split strike iron fly. All right. Now I'm going to use the term butterfly. I use iron fly, call fly, and put fly pretty interchangeably because they're all the same. All right. And if you don't believe me, let me just briefly show you the synthetics here. We'll use Nike. Oh no, we'll use Apple. And let me just briefly show you this. So this is, we're just going to look at a call fly. So 1, 2, 1. So it's the 105, 106, 107 call fly. And then if you look at the wrist chart, there's the fly. All right, now, if I do the iron fly, it will have the exact same P&L characteristics. See? Exactly the same. So I'm going to use them interchangeably. But in this case, this example is all an iron butterfly. So let's look at this. This is Apple 106, 108, 109, 111 iron split strike fly. So the wings, so the 106 put and the 111 call, we're going to look at bids. I'm only going to trade on bids. So I'm selling bids and buying bids. So the wings are 21 cents. The thorax, which is the 108 calls, excuse me, the 109 calls and the 108 puts is 108. Well, that explains. I knew I had some math in there wrong. Pardon me, folks. I had a baby last week. I'm sometimes a little tired. So the fly is 87 cents. $108 minus 21 is 87. So now the next day, let's look at it. On Tuesday, the 106, 111 decays to 9 cents. And my thorax, my 108, 109, is 80 cents. So in that day, I made 16 cents per butterfly. $0.16 for butterflies in a day. The following day, it's now worth 72. That's usually a good sign to be done with your trade. When your trade decays and then goes up a penny the following day, it's time to call it the entire trade a day. And now let's look at what happens on Friday. So on Friday, at expiration, guess what? It's now worth $1.01. So you went from being up 16 cents a fly to losing 14 cents a fly because you tried to take the position into earnings. In truth, the margin on that was, 113. So it was 11.30 a fly. And the next day, I make 16 cents, or about 160 bucks on a 10 lot. What's 160? What's $160 divided by 11.30? Guys, what's your math on that? We'll call it 15% on a 10 lot. Yeah, 14%. Great. That's not bad. In a day, I will take it. Now, you're going to say, but Mark, what about the commission? All right, let's talk about the commission. Your commission should be far less. The worst commission my students get, the absolute worst commission my students get on Live Vol X for Lightspeed is 60 cents a contract. So if I did a 10 lot, that's 40 contracts. That's 24 bucks in and out. So $48 total. And that's the worst case. Most of my students get less than 50. Most of my students get about 50 or lower. So if we just did 50 cents a contract, we're talking $20 in and out. Well, 120 divided by 11.30 is over 10% in a day on that fly. By getting in Monday night and getting out by Tuesday, you make you walk away with 120 bucks on $1,100 of risk. You target that in a few different flies. You target that in a few different butterflies, and you're in great shape. If you're just learning to trade, winning, is this just for earnings or in general? This is in general. This is for this week. This Apple trade was this week. And look, it's not like volatility really moved. It's not like the stock moves for 3 days. And then Friday, the stock tanks. So the key is don't get greedy. All right, weekly butterflies are a lot like punching a person that is much bigger than you. You ever gotten in a fight with anyone way bigger than you? Do I use toss? Not very much. Andrew does. I do not. If you trade index options, using Thinkorswim is borderline impossible, especially if you trade a lot of VIX, which is what I do. Yeah, you're playing kind of that little overnight decay, and you're playing a lack of movement. You're really playing gamma. All you have to do is say, I don't think Apple's going to move between today and tomorrow. That is a lot easier of a trade than guessing what Apple's going to do next week or 2 weeks from now. All right, so if you've ever gotten, I'm only 5'8.5", so every fight I've been in, the person was much bigger than me. So the key to fighting someone much bigger than you is get one hit and then run like hell. All right, and if you can, get him in the crotch. No, I've never done the low blow. But the key is get away at all costs. Now, sometimes if you pick a fight and you punch the guy really hard and you try to run, he ends up being very fast and he catches you. That will happen with these little flies. But if you pick your spots and get out, if you take the easy money and don't go after the hard money, you can do really well. Yes, I want you to think about weeklies. Maybe a little less on the calendar side, but certainly with butterflies. I want you to think about them as hit and run. All right, so now, when picking a butterfly in a weekly trade, the key is to think about the next 2 days. That is it. What is going to happen between now and then? I don't care what you look at, calendar, candles, Bollinger Bands, news, volatility. You need to have a 2-day outlook. If you are in a weekly butterfly for more than 2 days, you haven't made money in 2 days, so does direction matter? Well, we're going to talk about that, but yeah, if you have a directional opinion with weeklies, it should be a 2-day outlook. When you're trading these little weekly options, I want you to think about them as a 2-day trade. So if you're in a trade for more than 2 days with weekly options, you're in it for too long. Scanning. So things that we look for in weeklies is we look for what we call imploding volatility. We want options where the volatility is dropping quickly. So you can see Alta had earnings, Intuit had some earnings, but you can see there's some big drops in IV. So those are the things that I'm looking for when I scan. So in LiveVol, we have OptionPit actually has our own custom scans that come standard in your platform, but they have some of their own scans that I really like, and the one I look for is imploding IV30s when I'm scanning for equities to trade. Now, typically, I don't like trading the day after earnings, but if I can wait a day or two, then there might be something there. Big Lots, Cub, Best Buy. All right, so Best Buy, I get earnings on Thursday. Go to the 3-month. Yeah, so now Best Buy has imploding volatility, and since that earnings pop, it's done zilch. All right, vol is low, but the vol imploded. So that might be a name that I would be interested in. Rackspace might be another one. When did they have earnings? They had earnings a few days ago. Oh, they must be getting bought. How do you decide which stock? So when I'm scanning, I'm looking for imploding vols. I'm looking for a name that didn't have earnings recently and doesn't have any major announcements coming up, that has weekly options, where I can get decent risk reward. Now I'm going to talk about that a little bit. So when I'm looking at Best Buy, and I'm looking at next week's weekly, Best Buy is trading $39.50 on the nose. So let's look. I can get $1.05 out of the 39.5 straddle. And then the 38s and 41s. So $1.50 wide, $1.50 and away, and I'm paying 18 cents for my wings. So if you look at this from a risk-reward standpoint, all right, what's Best Buy's range been? Obviously not the last 10 days. But the last few days, I had that big up day, had a little fall through, then came back, closed 39.5, closed 39.5, closed 39.5. All right, how am I choosing my wings? On these little weekly flies, I typically want to buy a put that's worth more than a dime, but not much. I want something where the delta is going to be below 25, where that decay is more linear. I want that linear decay as opposed to the decay that is explosive. So I was looking at these 15 deltas because, all right, if I pay 18 cents for this strangle, all right, what's it going to be worth? All right, well, let's take a look. Obviously, we got some nice movement here, but let's look at end of day from Wednesday. All right, so Wednesday, vols are actually higher than they are right now, 28 versus 25. The stock settled 39.5. What are those wings worth? The 38s are worth 4. The 41s are worth 7. So those would be worth 7 cents so they've lost 11 cents in 2 days. All right, meanwhile, what about my straddle? My 39.5s are worth 78. So that'll be 71 cents from 90 cents. 19 cents comes out of that. And that's with vol 3 points higher. If next week is like last week is really what I'm looking at. I mean, you can see what's fascinating is that on the following day, that Wednesday, my 39.5s are now 52.5 cents. And my strangle is still worth 3 cents. It lost 4 cents a day for 3 days. That's linear. Meanwhile, my straddle that I was short at $1.05 is now 53 cents. So it lost it exponentially. Do we understand that setup? You want to find stocks that aren't going anywhere, where the implied vol is imploding. That makes sense? Great. All right, I'm back. You said open when there are no events. So like Best Buy after earnings, but IV dropped it. Right. It's okay for IV to not be high for a butterfly. In fact, one of the things you'll find is generally you don't want super high vol for butterflies either. Most of these trades work better in a relatively low vol environment. Butterflies, you want, the real key is the lack of movement. You want just absolutely destroyed realized volatility. So we're looking for imploding, but still somewhat high if you can, or above recent lows, if you can. And really the key is imploding realized volatility. So you want the movement to be dying. All right? So with butterflies, a falling implied volatility is important. A dying realized volatility, dying movement is the key. All right? And prior movement should be normal, not crazy. You don't want anything crazy having happened in the last day or two. And now skew if you can, what is skew? Skew is the relationship of calls to put. The flatter it gets, the better the trade. The less you will find that if you can pay nothing for your wings, or you can find cheap wings that are around 15 delta, you will make a lot of money on butterflies. And here's a blank page. And here's skew. So what I want you to pay attention, this is Apple. And this is, and what I want you to look at here, here's like 106 right here. All right, where is kind of the optimal place to buy and sell premium? All right, do I want to be buying the stuff down in here, you think? Or up in here? All right. I don't want to buy this. I don't want to buy this garbage. So like when I'm looking at my Apple butterfly, yeah, when I'm looking at my Apple butterfly, so we'll look at these. Here's the 107. So that's my at the money. There's the 106s and the 105s. So if I'm doing the 107s and the 106s and the 108s, that might be my trade I want to set up for next week based on where vols trade. The furthest out I'm really going to want to trade this Apple spread. All right. I don't really want to own anything up in here. So in this case, the way they're structuring the vol premiums, and obviously this could change Monday. All right, this is end of day Friday. Things trade certain ways. But if I was going to do end of day, I mean, it is absolutely, they're begging me to collect 80 cents for that 1 point fly and look for it to not do anything on Monday. I mean, they were begging this trade to collect 80 cents based on where the vols are. So this is the key. This is the number one reason for a fly success. All right. Obviously, the setup is important. Imploding volatility, imploding implied volatility, and then absolutely dying realized volatility, 1 and 2, and then in the actual trade structure. So those are the conditions. So the number one condition is imploding realized volatility. Realized volatility is movement. So if I pull up a chart, the number one thing I'm looking at is what's going on with 10-day vol. Where's it going in 20-day vol? This is the last 10 days. It's just been, you can see it's been imploding. Now, I want to make sure I'm not just selling the absolute bottom. Right? Then the next thing I'm looking at What's going on with implied vol? It's actually creeping a little higher. All right, so I'm going to be looking Monday morning for this. If I want to put on a butterfly, on Monday morning, I want to look for this volatility coming down a bit. I want to sell into the vol dropping. And then finally, so those are going to be the conditions that make your butterfly good. The setup, the actual trade structure, the number one condition is not what you get out of the straddle. It's how cheap is how cheap are the wings. If you buy your wings cheaply, all right, you can win nicely, easily. Now, how do you learn where wings are? The key is really paying attention to a grouping of stocks. Most of us have 20 stocks that we watch. Start paying attention to, just mark down all right. I know that that a lot of you follow 20 stocks. Well, take a minute and mark down how expensive the strangles are over a couple of weeks on, Monday and Tuesday, and you'll start to realize where these things should be priced. I can tell you an apple, 80 cents for a 1-point fly is probably too much. So you need to become once you you need to become familiarized with the personality underlying. Not necessarily. I think at the beginning the answer is yes. And the question was, so I need to understand the underlying really well. When you're first learning to trade these things, I think that's really valuable. But as you become familiar with what really constitutes inexpensive and expensive skew, you'll learn to pick that out almost immediately. So what I'm really discussing is a method to really learn how to analyze skew. All right. So try to buy the wings before skew permanently goes out of whack. In opposite conditions, do you ever use short 1-2-1s or yeah? And I'm gonna talk a little bit about broken wings and 1-3-2s. All right. I don't use those. I use those when I have a little bit of a directional bias I'm setting up, Mike. I typically don't use those for at the money. That's not really what they're structured for. So yeah, there's that skew again. Now that we've discussed it, well, I don't want to buy an option that's further away from the money than this. You may have to, there's always going to be some little positive vol to a put. All right, and then I'm not going to want to buy anything up in here. All right, now when out of the money puts are less expensive than out of the money calls, do you know what that typically signifies? In an equity, you know what that symbolizes? A top. So now, managing a fly. All right, the fun thing about these weekly flies is that there often is no management. I'm a big proponent, especially when getting started, of get in, get out. And if it goes against you, take money away. Take it off the table. Take flies off the table. Oh, the axes are, here's the strike prices, here's the implied volatility. So I think the key to these little weekly flies is that there is no management. If it goes against you, so if I put it on and it doesn't work, usually the next day, if it goes against me, you know what I'm buying my butterfly back for, typically? About what I sold it at. So I lose my commission. But if it works, I make a bunch of money. Only in a worst case scenario where the stock really, really moves. All right, should I, what does it tell you if out of the money puts are more expensive? Almost nothing. That's standard. So you don't try and adjust so if you don't try and adjust and you just take them off when they don't work, did I just say work? When they don't work? When they don't work, they are going to be in way better shape. All right. So now, so the next key is, all right, so you think you're smarter, you're too cool for school, you're smarter than the average bear, and you want to do some adjusting. Well, I'm just going to give you a couple of quick tips because I'm really not a proponent of doing a lot of adjusting. Here's the adjustments we will do. One, we never add margin. So we never do something that adds risk to the trade. So what do I mean by that? Oh, my butterfly didn't work. I'm going to add another butterfly somewhere else. That is the quickest way to blow up. All right, now, the ideal days of the week and the days expiration at it. So I'm looking to typically do this, so please clarify the ideal days. I'm typically looking to get in on Monday or Tuesday and out before Thursday. All right, Wednesday preferably. And if I'm in Monday, I'm out Wednesday. If I'm in Tuesday, I'm out Thursday. Now, if I have a weekly butterfly on and it moves against me, and I absolutely refuse to close the whole trade, the alternative is to start buying back parts of the thorax as they go away from you. So let me show you on the risk chart. What else do I have in there? Oh, whoops. So let's say this goes against me. Apple starts to rally. You know what I might do? And obviously the P&L is not going to be correct. What I might do is buy a couple of my 107 calls back. And then if it moves the other way, I can either buy a putback or I can sell my calls right back. So how do you know a trade is going against you if it's worth the same? Gamma increasing? If it's worth the same the next day and the stock moved, you're lucky, close the trade. If you put on a trade, and if you put on a trade in a little butterfly, and you don't make money the next day, you are in the wrong fly almost all of the time. Wow, this thing was nice. Wow. I did this little Amazon 3x2 that's up here, that was up, we almost put this in the strategy letter. It would have been a huge winner. So, the key is, almost, well, I put it on. It was a nice trade. So the basic management is as simple as slowly buying the thorax back as it moves around. That's it. Don't go crazy. And anybody out there saying just add butterflies is looking to blow you out. Yeah. I thought you were golfing. All right, so now let's talk about any questions on non-directional butterflies before I get into direction. Any thoughts on split body flies? All right, well, you need that at the money, like strong decay. So if you're going to do a split strike fly, don't do it more than like a strike away. So in my one example at onset, I was at the very front of this thing. I talked about the 106, 108, 109, 111. Well, Apple was trading 108.5. So when Apple's kind of right in the middle, then absolutely I like doing it the 108, 109. But much further than like a strike away, you're kind of losing the whole advantage of that exponential decay. Does that make sense? Good. How do you determine how many contracts of the thorax to be bought back? All right, so if you're going to, I would propose if you put the fly on and then it moves and you can buy it back for the same price, do it. Now, if you insist on covering the thorax, you want to cut your delta in half. All right, at a minimum a third, preferably a half. So buy enough calls or puts back to cut your delta in half, or at a minimum 1/3. All right, so now let's talk about setting up some directional butterflies. And this is really where I use butterflies and weeklies a lot. So recall the rate of decay of out-of-the-money options. Recall those insurance values take forever. So what type of trade can do really well in weeklies is a directional fly. All right, so if I buy the stuff that decays slowly and I sell the stuff that decays as slower, then buy some BS out-of-the-money option, it can make for a cheap, slow decaying, long gamma fly that really takes a good look at direction. So here's Facebook, or the Facebook as I like to call it, because I'm old school. All right. So take a look. So this is Facebook. You see Facebook, this is on Monday. Here's Friday. So the Facebook, if I do the 124, which is the at the money, 126, 128. All right. It's worth 45 cents on Monday. It's worth 95 cents on Friday. It's never worth less than the opening cost, and the stock went nowhere. It went up a little bit. It was a stock that had directional bias. All right. And the nice thing is if I'm right, my 124 calls go from kind of being at the money to the decay slowing down, and my 126s go from being out of the money to the decay speeding up. The decay entirely flips on me if I'm right. So when I set these things up this way, where I'm long and at the money and short directly out of the money, and then long like a cheapy wing, stocks can go nowhere and I can make money. And what I really end up with is basically owning the 124 call for nothing. And what do I look for? Well, in this case, I'm looking for Facebook. I think it's going to rally. And I'm looking for low implied volatility. This is one, when I'm doing these directional trades, if I'm going to buy that at the money option, in this case in Facebook, this implied volatility needs to be low. What's the ideal situation with real vol and IV relative to each other? Meaning, does IV need to be higher than real vol? What happens if they are? So, Andrew, one of the problems with looking at just real vol is that it's backward looking and IV is forward looking. So you have to have a real vol forecast, and you need that to be lower than IV. It helps to be able to look backwards, but really you're looking at a real vol forecast. These can be great. So the question was, on directional fly, since IV rises as price falls and detrimental to fly, are these for bullish trades? No, not at all. Because when I buy that at the money option and it moves toward my wings, these are these little weekly options. These don't have, the only Vega in the option is really that at the money option. Where do you get a real vol forecast? It's called, you do it yourself. I think the Volex guys used to. I'm not sure if they've got anything up there now. Yeah, so they don't have anything, but they used to. So the key is that you're actually owning some vol here. How many more slides do I have? 47. Jeez. Oop. All right. So the setup, buying at the money. Oh, well, the key is that you're buying extremely low volatility, and that at the money actually has Vega to it. That's the only option that really has any true Vega. So if volatility is truly too low and the stock is about to move, so in this case I'm actually forecasting movement. If I buy an at the money and then I sell something near a quarter and I'm right, and then I buy that cheapy wing, that Vega from that at the money on that initial move, that really you're going to make your money on the fly, bullish or bearish, on that first move when implied volatility increases, right? So if I do this trade in Facebook, what I was really hoping for is I buy the 24, 26, 28 fly, and the next day Facebook moves up 80 cents and implied volatility increases. Or Facebook moves down 40 cents and implied volatility increases a lot. So what you end up doing is ending up owning an at-the-money option at a huge discount. Again, I bought that at the money for 45 cents. So now let's talk about a true low vol bull trade. JP Morgan is 25.80. And you could these you could do in puts as well, but I like them better for bullish trades. So JP Morgan is trading 65.80. On Monday, the 66, 66 and a half, 67 fly is 11 cents. Vol increases, the trade goes nowhere. And on Thursday, even though I'm wrong, even though nothing happened, vol went up. The trade is still worth 12 cents. You know, you could look and say maybe it's worth 13 or 14 based on the bid-ask spread of the 66s. Those are 4 cents wide. They were 2 cents wide here. So you could maybe say, hey, you know, it's really 13 or 14 cents. But it actually is worth exactly the same going into the Yellen thing. So I can make a decision. Do I want to just call it a day and break even? Or do I wait until Yellen? Well, on Friday it traded over a quarter. 50-cent wide spread trades over a quarter on Friday at its high. Settles 15. I love these little cheapy trades in ultra low vol stocks that I think, because one of the things is that, yes, there's such a thing as low volatility, but a lot of times in the low volatility, what does the market actually have to it a little bit? You know, what's happened as the VIX has went from 13 to 11? Options got cheap, but what direction did the market move? Yeah, it had momentum to it. And typically, when vol's in the toilet, there's some upward momentum. So buy an option in the direction you want the underlying to move. It can be bearish or bullish. Should be worth less than 25 cents on a normally priced stock under 100 bucks and below a 20 vol. Is that a typo? You have the wings and the thorax. No, it's the 66, 66 and a half, 67. So options should be worth less than 25 cents on a stock worth less than 100 and a vol below 20. It's okay. Sell an option worth at least 10 cents against it and buy an option worth 3 or 4 cents. You really want to pay less than 10 cents on the package, but as much as 15, and these are typically going to be 1 point wide. On the directional flyer, the days of the week, the same. You can do these whenever you want. When you think there's going to be some movement. When do they work best? If you have an opinion, Monday afternoon. That's the time to put these things, to slap these things on. Repeatedly, we see that selling options is really good Monday morning. In these things, if you set your flies up right, Monday morning and Tuesday afternoon are the best sales, and Monday afternoon and Tuesday morning are the best purchases. I mean, until you win. Now, if I put on a trade that costs me less than 10 cents, and I'm looking to make 100 or 200% on it, well, I may just let these go out worthless when I do them. If I pay 10 cents for that spread, with my commissions, it's really 11 or 12. So if I sell it back at 5 cents, I'm really getting 4. It's often not worth it. So I like these. These are really conviction trades. You have to have a conviction to this. But the way they pay out is so high if your conviction is right that you can afford to let the losers die. So if you are right 50% of the time, that should be your goal. And your wins make 150 to 200%, and your losers lose 100%, you're going to be in great shape. So a directional fly, and really this is the way I like these, a directional fly can be a broken wing with the upside wing closer or of equal. All right, and I'm looking to make 7 or 8 cents out of it. And then close on Wednesday. If it's break even on Wednesday on your little directional fly, you can close it. So if I put on the thing for 10 cents and on Wednesday or Thursday it's worth 10 or 11 cents, just close it. All right, now, if you make any thoughts on diagonalizing the long wings to get less decay, that's Andrew's going to cover that stuff. Would you consider selling a non-directional fly to finance it? I might consider a put spread to finance it. So if I have a directional opinion, I might consider selling a put spread to finance it. But really, I almost never do. I end up doing broken wing directional flies more often than I do regular. I have a penchant for these broken wing flies. I love them. All right. So if you close your washes and you make 7 to 15 cents, 7 to 20 cents on a fly, I'm gone. And then you let your losers die, you will make money. So now let's talk about a broken wing butterfly. So the key to a broken wing butterfly is that you buy an out of the money that is right at the edge of the cone. All right. I love broken wing butterflies in weeklies, and I love them in indexes. Not as much in stocks, because stocks can really run. Indexes don't. So with a broken wing butterfly, what I'm really looking to do is buy an option that's maybe just out of the money. So this is one I like for next week. This is one I'm going to actually look at on Monday. The SEP2, 219.5, 220, 221 broken wing fly. I'm going to collect 2 or 3 cents on it. Now, why is that such a great trade? Well, if I'm wrong, who cares? All right. If I'm right, and we're in a really low vol time, right? Right now, SPY closed 217.19. So unless I'm looking for a 30 handle run, a 30-point run, a $3 move in SPY next week up, I'm going to be in great shape. And if SPY completely takes off, one, I can manage the trade, and two, I'm only going to risk 50 cents. I'm risking 50 cents I'm risking less than 50 cents, 46 cents to make 50 cents. And if I'm wrong, I win. All right. I almost, especially in indexes, I almost never do a directional standard butterfly. I almost always do broken wings for a credit and 1 by 3 by 2s. So there's what that trade looks like on a 10 lot. It actually pays out better than that. So if I'm wrong, so if on a 50-50 bet, you know, everybody, all you toss people love those probability cones, right? Oh yeah, well, probability of profit is this, probability of profit is that. Great. So my probability of profit if the SPY goes down is 100%. All right. Now, my probability of a win, well, what's a 1 week standard deviation in SPY right now? Well, the at the money vol is 12. All right, so now what is 5 divided by 252? I take the square root of that. Look at my calculator up. You should know, if you don't know how to calculate standard deviation, you shouldn't trade options. So 5 divided by 252. Take the square root of that. I multiply it times my implied volatility. And then I multiply that times the price of SPY, which is 217.30. $3.67. All right, so basically puts it that I have on this trade 100% chance of winning if the standard on its lower band of standard deviation, and I collect all of the upper band, right? Because what's 367? What's 217? Because 217.30 plus 367 is 220.97. So so I've got an 80%, about what amounts to an 80% chance of winning on this trade. And what I think is a really nice risk reward. All right, so I've got an 80% chance of winning, and I'm looking to make, I'm looking to collect 4 cents and sell it back at 10. Now, managing this thing. So in the broken wing butterfly, I'm shifting the risk side beyond where I think the price will move. Correct. I want my two shorts to be about the absolute limit I think this thing could move. Risk reward may seem screwy, but it isn't, because it makes money easily. I love these in index and ETFs, and it allows me to pinpoint target prices. All right, and when I'm right, I can hit an absolute home run. If you manage delta on these things, you can do great. And when you're wrong, if you're typically wrong on, the momentum is there, you can buy options on the way up and do extremely well. If I'm wrong on this butterfly or on this thing, you know what I can do? I can keep buying the 219.5 calls. Stock moved higher. Stock moved higher by a lot. I'll buy a 219.5 call. Move more. I'll buy another one. The next thing you know, you're long all these options. You've done great. Why not set at the 3? You totally could. Now, a second iteration on this is the 132. All right, these are a little better. It's bullish trade. These are great for bearish and bullish trades. Either way, this is actually a bullish trade. But here's one in Alta that I like. And I think the big difference out of these is that the way the delta moves. It's these are a little bit more. These are a little better with an early move. With a broken wing butterfly, you kind of want that move to be really slow. With a 132, you almost don't mind if it moves the other way. And 2, if it does move against you, it's a little more responsive. It doesn't hurt you as much. It's really kind of a taste. I like broken wings. But these 132s I like for, they can be a great way of playing direction and kind of taking the other side of the current move. It can be a cheap way to acquire delta. It's also a great way to sell volatility. So these are awesome when kind of that near the money volatility is way too high. This is a bullish trade. Yes, that is mismarked, Frank. When do I use the 132? Like I said, a 132 is more of a counterplay. So you use 132s when you think there might be a reversal. As a way of acquiring cheap deltas, and these are a little more durable if momentum moves on you. So if it has a little more momentum, a 132 is more durable than a broken wing butterfly. Broken wing butterfly is really a major play on low realized volatility, low movement. All right, you can get away with more movement on 132s. If you take our platinum class, Adam Singh, who's kind of the expert on 132s, does like a crazy class on it with Andrew. I mean, he makes a living trading these things back and forth. And the guys that are really good use these to acquire cheap directional opinions. But you see, the risk reward on this one is very different. It has a much clearer change in delta over a day or two than the broken wing. And the other advantage of the 132 is that it's much better for like equities, because a lot of times equities only have 1 or 2 strikes that are actually in place. The 132, typically the thorax is out of the money. All right, so the nice thing about these 132s is a lot of stocks don't have a lot of strikes in play. So let me look at like let's just look at Best Buy. You know, we've established it's got low vol. It's trading 39 bucks. Let's look how many strikes are actually in play for next week. I mean, legitimately, it has 2, maybe 3 strikes. I mean, $1 beyond Best Buy, and you're paying 17 cents. So if I was going to set up this trade, really, my only option is a 132 rather than a broken wing butterfly. And I can get a credit on that, which is nice. Thoughts on distance between strikes and 132, like a 1, 0, I don't know. I'm not quite sure I understand that. Now, some of the guys trade these very differently, but this is the way I look at them. I mean, this is, if you think Best Buy might creep a little higher next week, this is a great setup. You know, let's look at how this thing plays out. Here's 2 standard deviations in Best Buy. Not bad. So again, it's a bigger play on movement. Are any of these 2-day time frames as well? Yeah, these could be 2 or 3-day time frames. Although with broken wings, you end up waiting a little longer. They're more like a 4-day trade. It can be as well. The key is, again, make sure it doesn't overshoot. Buy that me. Now let's talk about briefly buying wings for direction, and then I'll hand you off to Andrew. The key is to look at the vol. Find vol that in IV 30 terms is at the complete bottom of the barrel. So here's that Facebook trade. If you think Facebook's going up or down, it is okay to buy a option Monday afternoon. Now, how long can you hold that trade? Well, are 132s, is 132 best with a low volume? It's great when you don't have a lot of options for strikes. So if you look at this trade, I mean, if I buy Monday, you know, I'm owning really cheap premium. I'm not going to lose a lot. And especially on momentum trades. I use weeklies, like I do a column for the street, and we've added in option pit kind of the option pit easy trade that we don't follow in the strategy letter, but are simple trades for people to follow along with if they want to start to learn how we think. And a lot of times what we're really looking at is volatility super low and in the toilet, and is there an option I can buy? But when I'm buying directional, all right, I am typically buying on a Monday, but I'm not buying that week's. I'm buying the following weeks or the following 2 weeks. and buy the first strike out of the money. That is the one that is going to get oversold. You have all of these call overwriters and put writers that just smash the first option out of the money. Get that momentum. All right. If you're bullish and there's a lot of open interest, or if you're bearish and there's a lot of open interest on that strike, it typically means someone has been slamming that strike with sales, and you're in a position to do really well on the move. So here's Facebook. This is a trade that the SEP 9, so that's 2 weeks out. I've got 10 trading days. Facebook's trading right at 125, and I can buy the 126 call for less than $1. I get all next week. I get the weekend, and I get all the following week. And I'm paying 95 cents, 93 cents for that. Now, I'm going to let Andrew get more into the calendar piece, but if you want, you can do it as a calendar trade and get at least a quarter. So, or better yet, make it a diagonal. Again, I don't want to stomp all over Andrew's trading because I know he's going to spend a lot of time on this. So, with directionals, don't buy the front week, buy the next week. If you can get out by Friday, that's great. So if I buy Monday afternoon and I'm out by Friday, I'm in great shape. If there's at least a quarter in it, 23 cents, fine. If there's at least a quarter in it, you can do a calendar or a diagonal. Yes, Andrew is going to email those out. Is it safe? Is it safe to assume that for a broken wing on 132, would you stick to the rule? No. With a broken wing butterfly especially, you may have to hold those till Thursday night or Friday. But what you may end up doing is buying the parts of the thorax you're short back for a penny or 2 cents or 3 cents. So you may convert it, and this is where we get into some nuanced stuff that we discussed in the chat room. You may want to cover the cheap thorax you're short if it gets super cheap, and just take the delta exposure that you own for nothing. So if I do a broken wing butterfly and I collect 3 cents, and then I can buy back my my shorts for 3 cents, and I turn into one to one, what do I end up with? I end up with a free call. Take that to the bank. So the key in making money in weeklies is profit taking. Small risk. Hopefully you understand this over and over again. What did I say? Small risk, small reward most of the time. Hit singles, you will luck into doubles, and this is the key. Cut losers and wash trades fast. All right? I make this mistake. I don't take my winners sometimes. All right? I'm eating a bag of poop on some weekly VIX puts that I was up a lot of money on, and I didn't close on Thursday morning. So in summary, weeklies, it's all about vol, it's all about price, it's all about understanding decay. All right, now here's the offer, and we're going to make this offer again at the end. All right, so you can do our gold course, which is the course. So if you're listening to this, you're going, wow, I'm picking up so much, but there's so many holes in my knowledge. The gold course, the gold membership, fills in all of those holes. Typically, when I get a gold member, what I say is go through silver, go through the entire gold membership course, which is 15 hours of education in modular format. So it's 8-minute bites in 12 chapters with a test at each chapter and then an entire test at the end. Then start going through these Saturday classes, and your understanding and the way you interpret what we say will completely change. So on top of that course on its own, which is worth the $19.50 we charge, and worth the $1,500 you can get it on the website for. All right, you get 4 months of Option Pit Live. Now, what's Option Pit Live? You get access to our chat room. You get access to our strategy letter, which follows trades from beginning to management to end. All right, yeah. And keeps track of the P&L. And you get the Saturday classes we're going to do for while your subscription is active, which is 4 months. And you get 1 session with me or Andrew. And email and phone support. It's really good. It'll fill in everything. And you're learning from the masters. The guys who taught everybody how to trade. You would be shocked how many mentors basically learn for how many guys say, oh, well, I learned from Mark and now I should run a strategy letter. Ha! You're dealing with the masters. We've just added our beginner trade. So some simpler trades for people to follow. All right, now you go to optionpit.com. You click on mentoring services. $1,500 already a steal. Sign up. Use that code SVOC, all caps, and bam, $11.97. What a deal. What a steal. I'm going to make this code good till next Tuesday. Then I'm killing it. This is our last time we're going to offer gold at $11.97 this year. Price is going up with the next course. Thank you. All right, now, if you've got any questions, feel free to ask away. Andrew's going to be on in 6 minutes. All right, guys. Excellent session. It does seem that flies are disadvantaged in bearish direction as IV rises from from a low baseline. A little bit. They can still work if you set them up right. Like you can set up out of the money butterflies that are actually long Vega and win, but Andrew's going to cover bearish calendars and you're going to be very, very happy. Andrew, Mr. Calendar Giovinazzi. All right. Will the SPY trade be on an Option Pit Live? We might put that on. I like that one a lot, Andrew. Are you or Andrew going to explain how to use the scanner? Yes. Not today, probably, but we can discuss that. We discuss that in the chat room all the time. Glad you enjoyed the presentation. For skew, are you comparing IV of the individual strikes or IV of the puts and calls? IV the individual strikes relative to each other. So yes. All right, folks. We'll take a 5-minute break, and then Andrew will be on, and I think you guys will be happy with him. Do you have an alternate to LiveLX to recommend? It's rather costly. It's free if you open a brokerage account. What do you think about that? it's within the strategy letter, Trevor. You have to read each strategy letter that comes out.